Is this the bear market? Although I think that the bear market may have started, stocks are currently ridiculously oversold. We will look at it from the point of view of market breadths, and I normally cover it in members only section, but today we'll cover it in the regular YouTube video. Yields on the 10-year Treasury notes broke down as fear spreads. That means bonds are rallying. However, the junk debt barely budged to the downside, and I think this is a bullish indication, and at the very least we might get a rally, a relief rally. I'll also show you what the current situation looks on a 4-hour chart like, and how you can trade it there. And we'll finish up with gold, which has likely topped, but does that mean the inflation was tamed? All this and more in today's edition of MasterChartsTrading.com market recap for Friday, April 4th, 2025. Please hit the like button, subscribe to this channel, share this video, ask any questions you like. If you're a subscriber, stay tuned. We'll be covering quite a bit of various securities. For example, Trump Media Technology stock will be covered in the members only section. Some of the euro, British pound, other forex instruments, crude oil, copper, Bitcoin, silver, all of this will be covered in the members only. And so some of the ETFs, large cap stocks, and some of the speculative stocks as well will be covered there. Throughout the presentation, I'll be using my proprietary MasterChartsTrading.com price action indicators, which you can see on this chart. This green, blue, red, and yellow lines. You can find out more about them by going in the link in the description and finding out more about them. So, how can I put this? There's no good way to put it. We basically tapped in mid-February, 19th of February, right here, this year 2025, and pretty much unraveled since. So today's action, this is S&P 500. The stocks dropped on average. So this S&P 500 dropped close to 6%. This includes the gap down. So yesterday price was at around this red line. Then it gapped down today and continued selling throughout the day. So by and large, this is extremely bearish. Candlestick, it's a gap and run lower, and it's a fully red candle, so there's barely any buying. Maybe there was a little bit of at the very end. So the bears controlled the price action throughout the entire day, throughout the entire session. Additionally, notice what happened. We closed below this yellow support resistance line, so by definition that implies a bear market for stocks. Now, even though the system says that yes, we're now in a bear market, I sort of am not terribly comfortable declaring the bear market just yet, because I am fairly certain we're going to get a significant rally. And where will this rally take us? We will try to figure this out. So, number one, bear markets are not all created equal. Some bear markets are tiny. So for example, the previous bear market, technically it was a bear market, began on 26th of April 2022. So remember this date, 26th of April 2022. And you can see that basically we had a situation where we saw stocks S&P close below the yellow line. We made a new low, and then we made kind of bounce towards the red line, made another low, again bounce towards the red line, another opportunity to sell short, and then made another new low. And then that's how we got to the October 2022 lows, and basically that was it as far as the new lows are being made. We kind of just rallied again towards the red line, sold off a little bit, but by and large that was it. And then we had a new breakout above the blue, so that implies a new bull market, and you can see it. That was basically since April 2023. Basically we had non-stop movement higher. So right now we do have a situation where we have a price close below this yellow line, so by extension that implies a bear market. So let's look at some of the other indicators for example, this previous bear market. So notice this April 26, 2022 break into the bear market. So we are going to currently look at high yield bonds, junk debt. So junk debt on that previous time, right now I'm hovering over January of 2022, and notice that the high yield bonds, junk debt, broke down into the bear market where I'm hovering on February 10th, 2022. Okay, so that's what happened back in 2022. S&P 500 did not break into that same bear market until April 26, almost May. So whereas the high yield bonds led stocks lower in last sell-off, currently we're not seeing the same picture. Right now we're seeing the opposite. We're seeing stocks lead the high yield bonds lower. So this is S&P 500 closing below the yellow line, and this is high yield bonds, JNK, barely budged. So yes, definitely, they got sold off, but notice where it landed. It landed exactly on this blue support resistance line. And in the previous instances, we had opportunities to buy around those same levels. So right now we have, if anything, we have a bullish divergence, whereas S&P has already broken into a bear market, high yield bonds have not. So in general, this is a good sign, and we can look at that from point of view of weekly time frame. So for example, on the weekly time frame, we can look at high yield bonds, and down below here we have what's called correlation coefficient. Most of the times, high yield bonds and S&P 500, they move together in lockstep. Not always, but most of the time. Additionally, what I was really looking for is a confirmation from the high yield bonds, which never came. So right now we have a situation where even though S&P 500 dropped into a bear market, high yield bonds have not. So that's another thing that I'm watching very closely. I also have like a list of bellwether stocks that I kind of follow, and not even a majority of those stocks have entered the bear market. So that's another reason why I'm kind of reluctant to just outright declare a bear market. Although the price action is quite bad, this was also quite quick, and some of those other examples, like for example, here's an example from pandemic, February and March 2020. The whole bear market lasted, a few weeks, technically speaking, and then we just continued higher. So the abruptness of this drop makes me think that at the very least we'll see a relief rally. Of course, we don't know if this is the end of it, of the drop, but the relief rallies always come. We just don't know exactly when. So we could try to see if relief rally is already materializing by looking at the 4-hour chart. And so let's look at the 4-hour chart. So number one, make sure you're using continuous security. In this case, I'm using contract for difference, CFD, and the ticker symbol is US 500, and it's from Capital.com. So right now we're looking at 4-hour chart. So each candlestick is 4 hours worth of activity. Okay, so right now, so what I'm showing here is this is the beginning of a downtrend on this chart. So on February 27th of this year, just a few weeks ago, really, over a month ago or so, the stock, the S&P 500 on the 4-hour chart drop below this red line, which implies a downtrend for continuous securities on the 4-hour charts, on the intraday charts. Again, it bounced, and then we had another opportunity to sell short. So big drop afterwards into mid-March, small bounce, and yet another opportunity to sell short right there on March 26th, followed by a huge drop, and then a very, very tiny opportunity where I'm hovering on 2nd of April. There was a very small chance that you would have been able to get in on the short side right there, and if you did, you're very successful. And then we had specifically we had this gap. Look at it right now. This gap between April 2nd and April, it was intraday gap actually, on April 2nd. And then it's just non-stop selling into the day until the very end of the day. Now, just looking at this chart, it looks very overextended. I mean, this drop was basically catastrophic. And you got those 3 red candlesticks. Notice one closed and another opened, collapse. One closed, another opened, collapse. So we had a, big just selling. Now, just looking at this chart again, I think it's way overextended. I think it's definitely oversold, is what we can say about it. Additionally, this gap is not even closed; it's only partially closed. So the gap from the 22nd, from the 2nd of April, is not yet closed. So it will act as an attractant for any kind of rally. That's why I put up here a kind of arrow saying that we might just bounce towards this gap area, which is around 9% bounce. We're currently around 5,060, so I think we could easily bounce to about 5,500 or so. So that level 5,500, let's look at it on a daily chart, and that's around the red line basically. So I think the bounce towards the red line is quite possible, something of this nature. And we'll need to basically look at when or if we get there and decide, do we want to, short it, or do we want to do nothing? Or maybe we want to just wait and see if it continues even higher, because it's not that far off from a new bull market. So technically speaking, right now we're in a downtrend bear market, but in either case, even if we're indeed in a bear market, I don't want to sell it short now. I at the very least want to wait for a bounce. And the bounce most likely will take us, as I just showed, towards this gap area at around 5,500 or so. So let's wait and see what happens. Yes, definitely not a good looking chart. We see a big drop. We see technically speaking, an entry into a new bear market. But as I said, because of the way the junk debt acted extremely resilient. We barely moved. So maybe let's wait and see until the dust settles. Maybe what we're seeing right now is a knee-jerk reaction similar to what we had during the pandemic. We had a very similar reaction during the pandemic, and then it kind of continued higher afterwards. Another one right there in December 2018, not really resulted in a major bear market. However, of course, occasionally we do get a true bear market, and in 2007 we had a big, true bear market. But right now we don't yet know if this is indeed what's happening. So let's wait a little bit, see what happens, and then make a decision when or if we see a bounce. And I think the bounce is very likely coming in the next few weeks to few days to weeks. Okay, so that's high yield bonds and junk debt. Okay, so I promised to cover market breadth. I normally cover it in the members only section, but today is a special day and I will cover it in the general market video. So currently we're looking at percent of stocks above the 200-day moving average for S&P 500 in the upper part here, and this is just S&P 500 in the lower part here. So looking at this chart, we can see that right now only 23.5% or so of stocks are above their 200-day moving average. Previous instance of this was back in 2023. You can see a big, it was quite oversold. It was like around 24%. And at that point, the rally started and it just continued nonstop. So right now we're seeing a deeply oversold level across the board. That was resulted from, multiple, pretty much everybody selling everything. Again, such deeply oversold market breadth levels usually result at least in a bounce. How far that bounce will take us is a different story, but it's definitely deeply oversold. There's no other way to slice it. Another measure that I look at is bullish percent index. You can look up what it means by going to chart school, and you can search for bullish percent index. It's an old kind of style indicator, but it's quite useful, I think. Also, same thing. Notice that back in 2023 we had very deeply oversold levels for this indicator, and we're currently around the same level, around 23% back in November 2023. We're currently right around there. So again, I think the stock market is deeply oversold, and I think a bounce is quite likely. Another one is a put to call ratio. So notice that this is from April 3rd. So we haven't yet seen an update from April 4th, and so it's not reflected here. But notice what's happening right now. Even yesterday was, selling not that pronounced from yesterday. We can see that this indicator moved into quite high category. We're currently we were yesterday at almost 1, so 1 put for each call, whereas back in February, the very low, as I was saying, that we're definitely over we were too much into call territory. So more calls, expect correction. Calls are bought when the stock market participants think that stock market is going up. Puts are bought when stock market participants think that the stock market is going down. So this is an opposite indicator. Whenever you see too many calls, you're most likely going to be expecting a correction. Does it always work? No, it doesn't. But when we have extreme readings, like for example, there was one in August 2024, and we had kind of like a drop towards the 200-day moving average here for the S&P 500. Yes, definitely we got a rally. So I think when today's number comes in, we will most likely see this this line go to like beyond 1. In other words, we're going to have so many puts that everybody and their grandma also thinks that the stock market will go to 0. Okay, so that's exactly when we see the opposite happens. We have more puts, we are expecting a rally. We currently have a lot more puts, and we're going to have even more once I see the number in a few hours. Definitely overextended to the downside, so we're expecting at least a bounce, as I just said. Finally, on a very short term, I'm currently looking at 10-day exponential moving average of the advanced decline issues. So how many stocks went up, how many stocks went down, and we have a number, and we're going to take a 10-day exponential moving average of that number, and then we're going to get a kind of like an oscillator. So this upper part here is that. Right now we're in a deeply oversold category, or rather territory. We're seeing this indicator in the negative 600 area, and notice that what happened before in December, for example, of last year, we saw a this reading in significantly negative territory, we got a rally eventually. Is this time different? It's possible, but whatever I've seen or learned within the stock market usually shows that at least a relief rally is quite likely. And after such deep, strong selling, I mean, today we dropped almost 6%. It's so unusual to drop that much in one day that a bounce is almost a guarantee. So we're looking right now for the very least relief these various market breadth indicators, as I just pointed them out, and most likely again we're going to get a rally in sometime next few weeks or so. All right, and of course a normal knee-jerk reaction to stocks dropping. We see 10-year Treasury note yield also dropped. In other words, people are seeking safety in Treasury bonds, and since bonds and yields move in the opposite direction, we're seeing a rally for Treasury bonds. So this is, for example, ticker symbol IEF, 7 to 10 year Treasury bond fund, and notice that it's been going up, and actually we just hit 52-week highs, I believe. Yeah, that's a 52-week high. So we are definitely trading the securities. So latest alert was back on 25th of February. Yes, definitely made some money there. So if you were able to get in, that's about a 3.5 to 4% move to the upside. So congratulations. These guys don't really move that much, this treasury bonds. So, it's not a very big move, but it's a good place to park your money if you have a lot of it. So that's what people have been doing. Basically, they're pulling money out of stocks, they're putting them into treasury bonds, and what happens? We're seeing treasury note yield drop. Today I just heard, or rather I was reading the news that I believe Trump is already saying to cut the interest rates, their interest rate cuts. So yes, most likely Federal Reserve will be forced to cut interest rates. Will it lead to inflation? We will try to answer that question in a few seconds, because we're going to be looking at dollar and various commodities such as gold and silver. Silver will be in the members only section though. So currently we're looking at US dollar currency index. US dollar is currently in a downtrend. So if you are able to sell the dollar short, then you would have been able to make some money recently. Today, however, very interesting action. See what happened. We tried yesterday to pierce through this yellow support resistance line, and the same thing happened today, but today we actually got a rally on the dollar in the face of all of that's happening. So it's interesting because some of the major currencies dropped versus the dollar, but some of the minor ones, such as AUD, USD, Australian dollar, collapsed even further in favor of US dollar. So it's as in New Zealand US dollar as well. So it's kind of interesting that by and large, on average, the dollar index actually rallied. So as I was getting to the next one, normally gold and dollar move in the opposite direction. So gold divided by US dollar, XAU USD. Right now, dollar suddenly is gaining, just gained today. Dollar gained, gold dropped. A few days ago, I wrote here top, question mark. Looks like we definitely are topping for gold. And I think a pullback, at the very least, towards this blue support resistance line, which is about 7% or $200, is super likely. So we're currently around 3,035. I think a pullback towards about 2,800 is extremely likely in the next few days. Another reason why I thought gold was topping is because I was looking at gold miners ETF GDX, and a few days ago I wrote here, or actually last Friday, shooting star. Is this a shooting star from last Friday? And I was correct. This was indeed the top. Notice the drop today was pretty significant, and these are gold miners. So what does that mean? Okay, so if gold is dropping and so are the gold miners, doesn't that mean that the inflation will be tame? Could that be possible? Yes, it's a possibility. We may not necessarily get inflation. We may get some inflation in some areas, but like on average, we're expecting gold to be the bellwether of inflation. I mean, is it? Sometimes it is, sometimes it isn't. Yes, gold has definitely been a very good trade, and we've been trading it. Notice this upward facing arrows. So all of those were definitely successful trades, and you made a very nice run to the top from the last one. It's from about 2,000 to about 3,000. So that's a huge, 40-some% move. But I think right now the top for gold could be in, and I think we might see sideways to down action for gold and gold miners in the near term. Again, what does that mean? Does it mean that gold is signaling that we're not going to have an inflation anymore, or it's not going to be as significant as people thought? So maybe this is a buy the rumor, sell the news kind of thing, and maybe that's exactly what's happening. So to summarize today's events and this week's events, technically speaking, bear market for S&P 500 and for stocks in general has begun. Some of the indicators that I also follow, such as high yield bonds not dropping into a bear market, market breadth being extremely oversold, as well as another index that I follow that I am not going to talk about right here, but basically I was looking at the number of stocks within my own index that have entered the bear market, and there was not that many of them. So the bellwether stocks still sort of are hanging in there. If or when they drop into this new bear market, then we'll make a decision. But right this instant, I'm a little reluctant to declare a bear market right now. I want to see where this goes. I want to see a bounce, and then we'll make a decision based on the price action. And then from then, at the very least, we will need to see a relief rally, and I think a relief rally is very likely from here. All right, that's it for this week's recap. Please let me know if you have any questions. Other than that, thank you for watching. Have another great trading week. Stay tuned on how to find me on the internet. So please go to MasterChartsTrading.com, click on sign up. So I have 2 products. I'm about to hopefully launch the 3rd product. Well, we have the bundle, trading indicators and newsletters, but I'm hoping to launch a 3rd product, which would be stock ratings. So stock ratings basically would show, like for example, last week Google went into a bear market, a void phase. So it would have shown up on your screen or on your report as a void. Something of that nature will be hopefully coming within the next few months. We're working on it right now, but for now you can also sign up for trading indicators and newsletters. And so the trading indicators are these lines on the chart, and again I make pretty much all of my trading decisions with them. You can trade pretty much anything under the sun on most time frames. For example, this is a 4-hour chart. You can see that you can trade it quite easily as well. Newsletters, I send out daily alerts and weekly members only video. to my members, this week we'll be covering various forex, some of the commodities, Bitcoin, ETFs, large cap stocks, and some of the speculative securities as well. Now, we are not yet shorting, we're not yet going to be selling short, but when or if a true bear market starts, then we'll start considering selling short. For now, we're waiting for more clarity, basically, at this point. So that's a newsletter. I send out daily alerts, and there's also a weekly members-only video that's going to be covering various securities. And of course, the best deal is to get both trading indicators and newsletters. And if you get a yearly subscription, you pay upfront for a year. That's an equivalent of $49.95 per month. You can also pay, of course, monthly. That's at $59.95 per month. All of the plans come with a free 7-day trial, so you have 7 days to cancel. And of course, I can answer any questions you like. That's it for this week's recap. Again, thank you for watching. Have another great trading week. Bye-bye.